Hello, everyone. It's another beautiful day here in the Midwest. It's a little bit cold, but nice nonetheless. My name is Joseph Lackland, and this is the pre-market morning report for today's date, Wednesday, May 6th, 2026. And if you notice, it is a couple hours past lunchtime here. So I am a little late for the report. I wanted to take some extra time and get together some materials for today's report. We have an incredible story developing here in the crude oil futures market. We've been covering the energy crisis in recent episodes, and this morning's news headlines are really something else. With the help of ChatGPT and Claude, I've organized them to the best of my ability. So let's just take a couple of minutes to sort those out, and then we'll go into the charts and see and analyze what exactly happened in the futures market over the last 24 hours. So a trip to zero hedge will display a few of the key news headlines that are driving the markets today. So we have this new one here. U.S. Navy jet fires on Iran flag tanker trying to reach Iranian port. This is new. We have an AI, banks are choking. That is market related, but not exactly war and oil related. I don't know what happened to the other article. It was here. It's gone now. I guess they got rid of it. Let's try and hit refresh one more time. It's gone. I just saw it. I put it up here for the video. It's gone now. So the other one was China wants Iran war end, pushes immediate Hormuz reopening during Araghchi visit ahead of Trump-Xi summit. Says Iranian Foreign Minister Abbas Araghchi is currently in Beijing meeting with his Chinese counterpart FM Wang Yi, and the timing of the visit sends a resounding message to Washington and the West. The highly anticipated Trump-Xi meeting is still scheduled for next week, expected to be May 14th through the 15th. Though there has been ample speculation, the ongoing events of the unpredictable Iran war and Hormuz Strait crisis could derail the trip at the last minute. Yeah, I would definitely call it a crisis. We're going to get into the metrics of that. I've got Claude here on task for some graphs and some charts going out to about the 12-month mark from now. We're going to examine the oil deficit and the cumulative effect of the oil deficit for the foreseeable future. China's oil supply is directly tied to Iran's production and distribution of oil and the surrounding Gulf states coming through the Strait of Hormuz. So China's economy is suffering greatly as a result of the conflict. So they're kind of tired of it. They want it to end right now, and they're going to push for some sort of resolution, whatever that is. So this China news headline about the war, this is a big deal. The other one is that the inventories were released this morning. Every Wednesday at 9:30 Central Time, they release the oil inventories, and this is what the oil report said this morning. It says WTI holds rebound gains as U.S. fuel exports hit record high, production dips, huge SPR drain. Oil prices are lower overnight, but dramatically off their lows. We'll look at the chart in a second. You can decide. Amid on again, off again optimism of an imminent U.S. Iran peace deal. Benchmark Brent fell as much as 12% to 96.75 a barrel in London, while West Texas Intermediate dropped up to 13%. European natural gas plunged as much as 14%. Oil and gas later pared about half of those losses after Trump said in a Truth Social post on Wednesday that if Iran doesn't agree, the bombing starts. Overnight, we saw huge across-the-board drawdowns in U.S. energy inventories reported by APR and a huge SPR drain. SPR is their Strategic Petroleum Reserve. All eyes on the official data this morning. API, crude minus 8.1 million barrels, minus 2.8 expected. Cushing down 1 million. Gasoline down 6.1 million. Distillates, jet fuel, things like that, down 4.6 million. DOE, crude, negative 2.3 million. Cushing, negative 648K. Gasoline, down 2.5. Distillates, down 1.294. For the second week in a row, U.S. inventories saw significant declines across the board, with products seeing the biggest draws. Crude's drawdown was a modest disappointment, especially after API's big report. And you can see the chart for the inventories right here. Overall, crude stockpiles remain elevated but are drawing down. So they're being drawn down. Total U.S. crude stocks. That's what this chart is. Perhaps most noticeably, the Strategic Petroleum Reserve is seeing massive drawdowns to support the global loss of supply from Hormuz. So the crude oil has to come from somewhere. That's what this is saying. The world consumption has not changed. The world continues to consume crude oil at its normal, maybe somewhat diminished rate at the moment, but it still consumes roughly the same amount of crude oil, and production and distribution is on a massive deficit to the tune of about 13 million barrels per day and counting. The strait remains closed. On the back of that draw, Bloomberg's energy guru dropped this stunning chart showing that on a 7-day moving average, global oil liftings into tankers have recovered to their pre-war level due to a surge in liftings in the Americas. Of course, that's helped by massive stock drawdowns, SPR drains. So there is some resupply going on, but it is directly draining the reserves, particularly the Strategic Petroleum Reserve. Additionally, last week saw U.S. crude exports actually decline after nearing the unprecedented level of 100 million barrels in 7 days. The decline in crude cargoes headed overseas pulled down overall U.S. oil and fuels exports from record high levels also set the week earlier, even as fuel exports rose to the highest weekly level ever. So exports and drainage of stockpiles is at a record high. The U.S. has sent out at least 1.5 million barrels of diesel a day since the week of April 3rd. That's this. U.S. crude production continued to trend lower. We're producing less and simply drawing off of reserves. WTI fell dramatically below 100 overnight, but amid Trump's bombastic comments and Iranian denials, prices are well off their lows. The crude started at 102 roughly and got destroyed down to about 89 before recovering to about 95, 96, and has basically not moved at all since the session started. So that is the inventory report article right there. This is the other one. This was the headline that's not there anymore. I don't know what happened to it. Fortunately, I have it open here. U.S. Iran deal closer means framework still being hammered out for month-long talks. This all began last night with Trump's Truth Social post that came out around shortly before 6 p.m. Central and 7 p.m. Eastern. So here is the candle. This candle begins at 550, 102.40 down to 99.20. That took about 15 whole seconds. So if we go to the 1 second chart, you can see that each candle is 1 second, and the average volume for each second is around 10, 20, 30 contracts at the most. So in 1 second after the Truth Social post, 250 crude oil traded, sent it from 102.45 down to 101.83, a 60-cent move. And then over the next 15, 20, 30 seconds, the crude crashed another 300 ticks down into the support here, which was the low that was made first a few days ago. Then the market proceeded to chop in a range for the next hour or two, then came briefly above yesterday's low, couldn't get above yesterday's low, chopped for another couple of hours, and then overnight, beginning at about London. So London came in, sat down to trade, and crude oil started going down. and it kept going down, and it went through several support levels, and it kept going down until it hit 88.50 roughly, and then it started to come back up. That was around 6 o'clock this morning, and look, it has not moved at all for basically the entire session. Now, I've never seen anything like this before. I've never seen the market not move at all during the day when the daily range is this big. So we had a massive overnight range, and there is absolutely nothing trading right here since NYMEX opened. The market literally cannot move. Incredible. If we look at the daily chart opened up here and obviously ended up down here and now is right here. We have normal sort of volume on a daily basis. We do have a 6% move. That volatility is going to go up a little bit because we just had a 13% break. And if we go to the gasoline chart, the gasoline went from 365 to 330. I was saying that if we did correct in the gasoline, that it would be some kind of catastrophic event, and that is exactly what we ended up doing. I was not able to really capitalize on this, even though I knew it was going to happen. The market pretty much made the entirety of its move overnight in about 2 or 3 episodes. So the activity was definitely not the easiest to get a hold of, and the initial shock with the Trump Truth Social tweet was definitely violent enough to make anybody scared to place any kinds of trades in this environment to begin with. So the stock market went up. We know that when the crude oil goes down and gasoline goes down, that risk assets go up. The gold got bought from 45.80 up to 47.30 roughly is the high in the gold. NASDAQ up another 400 points. Market keeps going up. In the E-mini S&P, the S&P is now almost at 7,400. So we have another stock market rally to the all-time high. Here's the NASDAQ. So we have a little bit of a pop right at Globex around the Truth Social post. Then in the middle of the night, London started buying, steady rally, correction, and then of course steady rally again. So it's moving around a lot, but over the course of several hours. We are getting some big moves in here, but they are gradual. They're happening over longer periods of time. Here's the ES. Here's that initial pop. Here's that push. Here's the retracement. Here's the grind. Nothing to see here, folks. All-time highs again in the stock market. Crude oil gets rocked 13%. This is the typical scenario we find ourselves in these days. Let's go to the ChatGPT interpretation of the Iran deal closer means framework. This is a pretty lengthy article. Let's not read all of this. With the help of machine learning, we can organize and sum up these points succinctly so that we can break them down quickly. Here's an itemized breakdown of the article theme and what the market appears to be reacting to right now. The core issue is that the reporting is changing almost hour to hour. We're getting this story, then that story, then this edit, then that edit, then this story disappears, then this new story pops up, then that story disappears. It's impossible to keep track of what's going on right now. And many headlines are blending rumor, negotiation leaks, military escalation, and market speculation together all in one. Main headline theme. Markets surged because reports suggested that the U.S. and Iran may be nearing some kind of temporary framework or memo agreement. Oil collapsed because traders immediately priced in the possibility of Strait of Hormuz reopening, reduced military escalation risk, Iranian oil eventually flowing more freely again. Bonds rallied and yields dropped because lower oil prices reduced inflation fears. Stocks rallied because lower energy prices are generally bullish for equities and risk assets. Gold is a risk asset, so gold went up too. What Axios market sources claimed reported negotiation points. The U.S. and Iran are allegedly discussing a one-page memorandum framework temporary ceasefire structure, pathway toward ending the current Gulf conflict. The report suggested Iranian responses on key points may arrive within 48 hours. Nothing is finalized yet. This is supposedly the closest both sides have been to a deal since fighting escalated. We've been close to a peace deal for weeks. Why the news feels convoluted. Deal does not mean final peace, a major issue in the reporting. Some headlines imply war-ending peace deal agreement reached, but underlying reporting actually describes a draft framework, exploratory negotiations, conditional terms, preliminary responses. The language keeps escalating from talks, framework, memo, deal, peace, even though nothing appears officially signed yet. Nothing has changed. The military buildup continues. The conflict is still going. Bombs are dropping. Bullets are flying. The Strait of Hormuz remains closed. The crude oil deficit remains at 13 million some odd barrels a day that the supply is not getting. Contradictory messaging from officials. At the same time, diplomatic leaks suggest progress. Military posturing continues. Threats of renewed force are still being issued publicly. This creates a strange environment where markets trade optimism while military risk remains elevated. Reuters specifically noted no final agreement exists yet. Independent verification was limited. Oil market is driving the entire narrative. The market reaction is really centered on one thing, the Strait of Hormuz, because a massive portion of global oil shipments move through it, in addition to lots of other important things, liquefied natural gas, fertilizer, rare earth minerals, elements, you name it. Disruption there caused oil spikes toward 120. Reopening expectations instantly crushed crude oil prices. So every rumor now causes violent oil swings, violent future swings, immediate repricing of inflation expectations as the market scrambles to interpret the information and price everything in all at once. What does this actually mean for the future? What is the reality of this situation going forward? What does that mean for us? How is our world going to look in the future? And this is from the events that have already taken place. So this is not a projection of what I think is about to happen. What I'm going to demonstrate and show here is things that are coming that haven't hit yet because of the delays that are associated with the type of crisis that this actually is. The oil 2026 crisis, two realities, one market. This is Claude on task here that took all the information that I gathered and compiled earlier and summed it up and made me a nice report that we're going to read together now. Physical scarcity versus financial optimism, the most complex energy dislocation in modern history. Financial markets are pricing peace. The physical oil system is behaving like a war is still on. Understanding why those two things are both true at the same time is the key to understanding everything that is happening in energy right now. Section 1, the choke point, Strait of Hormuz. What is closed and why it matters. That was a little weird, the wording that it used right there. What closed and why it matters. Beginning in late February 2026, the Strait of Hormuz, the most strategically critical energy choke point on the earth, became effectively impaired due to military escalation between Iran and the United States. The United States launched a full-out attack on the nation of Iran. This single waterway normally handles roughly 20% of all global oil flows, plus massive volumes of LNG and refined products. Even a partial disruption cascades across shipping, insurance, refining, and global inflation expectations, and also has massive downstream effects on almost everything else, which I will get to in a little bit. Normal daily flow is about 20% of global oil through there. Crisis began February-March 2026. Now months into the crisis, duration shift structural from daily to cumulative. Largest daily supply shock in modern history. Estimates from Reuters, Kepler, ING, and S&P Global place the current disruption at 10 to 13 million barrels per day. removed from active global markets. Some worst-case windows approach 15 to 20 million barrels a day of affected flow. Compare that to every major oil crisis on record. We have the 2026 crisis, that's today, 13 million barrels per day. 1979 Iran Revolution, 5 million barrels per day. Please mind my wind chimes. 1973 Arab embargo, 4.5 million barrels per day. 1990 Gulf War, 4 million barrels per day. By daily volume, the current disruption is the largest instantaneous supply shock in the modern era, roughly 2.5 times the next largest event, and that's almost more or equal. That's almost equal to or more than all of these combined. The barrel math, close to 1 billion lost so far already. Because the crisis has run for months, cumulative losses have compounded into historic territory. At 13 million barrels over 65 days, the math alone produces 845 million barrels, aligning closely with independent analyst estimates. Here's the source, Reuters, 500 million cumulative, ING 850, Discovery Alert approaching 1 billion, running total, S&P Global projection 1.5 billion if extends to June. We got a couple more weeks until June. June's going to come around pretty soon. Doesn't look like the strait's going to be open anytime soon either, but that may change. Section 4, the U.S. response, America as emergency supplier at a cost. So this is the reality that a lot of people are not paying attention to, nor do they have any clue about. As Middle Eastern exports became impaired, global buyers pivoted aggressively to U.S. crude and refined products. The United States became the emergency balancing supplier for the entire global oil system. I'll read that again. The United States became the emergency balancing supplier for the entire global oil system. Crude exports, 6.4 million, record high. Refined exports, 8.2 million total products. Diesel exports, 1.9 million. Critically, this surge is not driven by a massive production increase. Analysts believe the system is being supported through inventory liquidation, storage drawdowns, and strategic reserve depletion. That was why we went through this article right here. Not new supply creation. Two hidden stress points markets are ignoring. Strategic Petroleum Reserve, the SPR, has experienced accelerated depletion with multi-million barrel weekly draws pushing levels near multi-decade lows. Governments do not drain emergency reserves unless real physical supply stress is active. Yet financial markets are pricing normalization. There's nothing normal about what's happening here. Diesel and distillates. Distillate inventories fell to the lowest levels since approximately 2005. Diesel is the fuel of freight, agriculture, industrial logistics, construction, and mining. Even if crude prices stabilize, diesel shortages can continue creating economic damage to those downstream sectors. Two parallel realities running at once. The core of what makes this crisis so unusual is that the financial system and the physical system are telling completely different stories simultaneously. Physical market, massive cumulative supply loss, shipping still impaired, inventory depletion ongoing, massive inventory depletion ongoing, SPR still draining, diesel shortages, record export strain on the U.S. without the production to back it up or balance it out. Financial markets, futures specifically. Peace headlines dominate, framework negotiations, oil prices collapse. This is the 6th or 7th time the crude oil has crashed in the double digits of percentages now since the war started. Equities and risk on rally, market keeps going up. It just continues to move higher. It is acting like things have never been better, when fundamentally, according to the facts, things have actually never been worse. Lower inflation priced in, de-escalation assumed. The prices of everything continue to go up. I have no idea where this lower inflation narrative is coming from. Markets appear to have rapidly shifted from worst case catastrophe, which is the reality of the situation right now, to complete and total normalization driven by rumor and diplomatic headlines rather than any actual physical resolution of the supply emergency. Nothing has changed. The strait remains closed. The war is still going on. The buildup continues. Yet the crude oil got smacked for 13%, and the stock market is still on the all-time high. How today's peace rally could cause tomorrow's crisis. This is the next move in the sequence. This may be the most underappreciated risk in the entire situation. Oil producers do not expand infrastructure based on spot prices. They rely on forward futures curves, multi-year pricing signals, to justify the billions in capital required to grow future production capacity. When prices collapse on diplomatic headlines before that infrastructure investment occurs, the signaling mechanism breaks. The market is designed very efficiently to find the appropriate balance of supply and demand for that supply. It's a delicate equation that true price discovery solves automatically by design. So if supply is low, then price goes up because demand goes up. There's less things available for the same amount of demand. The premium goes up. The market reflects that. The prices are higher. Companies know because prices are higher to invest in infrastructure and upgrades so that they can extract more crude oil out of the ground. Without this signaling mechanism, they don't know what to do. So this massive problem that we have in the deficit of crude oil and everything else is not going to be solved in the future effectively because the pricing mechanism does not function. Disruption creates genuine shortage. Physical inventories drain, prices spike. Markets front-run diplomacy. Peace rumors send prices collapsing before any physical resolution. The problem is not solved, but the price acts like it is. Producers see unstable forward curves. Multi-year price assumptions become too uncertain to justify expansion capex. Expansion projects are delayed. Drilling programs, infrastructure, offshore development all stall. Physical inventories keep draining. The underlying shortage doesn't resolve just because prices fell. Supply shortage reemerges harder. With no new capacity online and reserves depleted, the next spike has less cushion. So the next time there's a real crisis, the safeguarding cushion that would have been created the last time there was a crisis is not there. In prior oil crises, high prices eventually triggered major supply expansion. In today's hyper-financialized, algorithm-driven market, that price signal may be getting destroyed before producers can act on it. Yeah, here you go. Here's your signal destruction right here. Nothing changed. The strait didn't reopen. The war didn't stop. Peace negotiations have not started. 13 million barrels a day still coming out of the global crude oil supply. 10, 12, 13% less than normal on a cumulative daily basis. The central question, what markets are really debating right now? Are markets correctly pricing genuine normalization or prematurely pricing peace while the physical oil system remains critically strained? That single unresolved question is what's driving the extreme volatility. Every diplomatic headline, every ceasefire rumor, every negotiation framework that becomes a market-moving event precisely because no one knows which reality will dominate. Nobody has any idea what's going on here. The result is a market that is simultaneously headline-driven, rumor-driven, diplomatically unstable, physically constrained, and highly reflexive. Complete insanity, in short. This next graph, I said, show me a chart of the cumulative deficit for the next 3 months and represent that in such a way that demonstrates that the oil has to come from somewhere. A cumulative deficit has very serious long-term consequences. Claude pumped out this chart. Total deficit over the next 5 months, around 1.95 billion barrels. SPR remaining estimate, 290 million. SPR buffer at crisis start, 350 million. We have SPR drawdown, commercial inventory liquidation, demand destruction, substitution, unmet structural hole. Unmet structural hole. This is the deficit that is going to be building as we progress through this. Where does 1.95 billion barrels come from? The answer is what makes this dangerous. SPR drawdown, 360 million barrels. Emergency reserve burning once gone. That's the entire SPR, by the way. So if the SPR is completely drained to zero, that's where some of this is going to come from. Once gone, it takes years and political will to rebuild. It is not a renewable resource. It's a storage. Commercial inventory, 720 million barrels. Working stocks that refineries, airlines, and industry depend on. Diesel hit 2005 lows. This is not surplus. It's operating buffer being consumed. Demand destruction. Factories shutting down. Routes canceled. Industries not running. Missing demand that represents real economic damage already done. There will be some demand destruction by default with the lack of activity. However, that is not going to satisfy the deficit. Structural hole, 390 million barrels. The unmet remainder. No source covers it. This is the supply the world simply did not get and cannot be retroactively replaced. This is what causes the damage. The things that weren't done, the deliveries that were not made, the processes that did not take place due to the lack of energy available. This is the structural hole in the energy circuit of the world. The long-term consequence, you cannot borrow oil from tomorrow. Every barrel from the SPR or commercial inventory is one fewer barrel available when the next shock hits, or when the strait reopens and refineries scramble to rebuild working stock simultaneously. The structural hole cannot be refilled overnight. New production takes 2 to 5 years to come online, and the price signal collapse from peace headlines is suppressing exactly the investment needed to build that future supply. The deficit does not disappear when diplomacy succeeds. It becomes the starting line for the recovery. Then I had it make one more chart. Show the percentage of oil missing for the first 6 months, and then the percentage of oil missing for the next 6 months a year total, assuming the strait opens today. Production does not go to 100% right away. So we can see the average deficit, phase 1, that's where we are right now. Active disruption, maybe starting to go down, maybe starting to go down a little bit, still very elevated. And then August reopens, and deficit supply is around 8%, and there's still a deficit, still a deficit, still a deficit as facilities come back online. Lots of facilities have been destroyed or heavily damaged due to the Iranian counterattack and due to the war in general. So it's going to take probably a lot longer for this to normalize once the strait is open and production begins to move again. Why the deficit doesn't end when the strait reopens. Tanker backlog, ships reposition globally, routing, insurance, and port scheduling takes 4 to 8 weeks to normalize even after the waterway is declared safe. It takes weeks for these ships to get there. Field restarting. Wells that were shut in or throttled back don't restart at the full rate instantly. Pressure management, equipment checks, and crew scheduling add weeks to months. Inventory rebuild demand. Every refinery, airline, and industrial buyer simultaneously tries to restock. This creates a demand surge on top of regular consumption, tightening supply further. No spare capacity buffer. SPR and commercial buffers were depleted during phase one. The system enters recovery with no cushion. Any secondary shock during ramp up has nothing to absorb it. The year-end reality still short with nothing left in reserve. Even on an optimistic reopening today scenario, opens today, war stops today, peace is declared, Strait of Hormuz reopens, the road to recovery begins. The world ends the year running a cumulative deficit of roughly 1.9 to 2.1 billion barrels with SPR levels near historic lows, commercial inventories depleted, and diesel stocks not yet rebuilt. The market that priced peace in 6 months will now discover in months 9 through 12 that peace does not equal supply. Physics is what they call it. You cannot circumvent the laws of physics. They are universal. The 1973 embargo reference line is the thing I'd highlight hardest on the video. It's given me a little explanation of what to highlight here. So the 1973 embargo, and if we go back, that was 4.5 million barrels a day. So there was a massive crisis with a 4.5 million barrel a day disruption. And we're at 13 million and counting, and several months before it looks like this is going to get better. So, in short, we have a truly extraordinary situation happening here where the oil crisis is the worst oil crisis in history, and we have the futures markets doing things that absolutely make no sense, and we have the stock market on the all-time high, continuing to price in a perfect utopia of perfection for the foreseeable future. It is truly historic what's happening today. It should be another interesting night tonight for those of us that are following the futures market. I can only imagine what we're going to see tomorrow morning on the news headlines. Maybe another military strike or something even worse, followed by talks of more negotiations and peace deals, which should give us another 13, 14, 15% range in crude oil, and should definitely prepare the stock market to another all-time high. So, with that said, I will see you guys tomorrow. Thank you very much for joining me. I will be on time tomorrow morning. Like I said, I was late coming in, so I decided to take a little extra time to prepare this special report. Good luck out there. Try and stay sane. It's a tough job, but somebody has to do it. And I will talk to you soon.